Welcome to Cash and Liability Mastery. Today we're going to talk about taxes. Specifically, what I think of as the three taxes that we'll spend most of your life addressing. That being income tax, capital gains tax, and dividend tax. So when we look at the primary form of tax in the United States is an income tax, often called ordinary income. And the most important thing to understand about our tax system is it's a progressive tax system. So when you hear about you're in a tax bracket, you're never in simply a tax bracket, because if you're in the 24% tax bracket, what that means is you've probably achieved an income based on your filing status that puts you in a 24% bracket. For example, if you're married filing jointly, and you're earning around $300,000 a year, then you're in that 24% bracket. But what a progressive tax bracket means is you're paying incrementally more taxes as you earn more. For example, over here, someone earning $32,000, they're not in a 24% bracket. I can say a single person earning $32,000 is in a 12% bracket because their highest income achieved in ordinary income status is a 12% level. But they don't pay 12%. In this example, they'll pay 10% on the first little less than $10,000, and then they'll pay on every dollar above this amount up to $32,000, they'll pay 12%. So let's look at this again. If a person makes $50,000, and let's say they're taxed as a single payer, they're going to pay 10% on that first about $10,000. But then as they move all the way up to the next bracket, these are off a tiny bit because the tax brackets change each year. You'll notice they pay 12%. And then in the next bracket, they're paying 22% on this difference over $40,000 and up to $50,000. So you're paying progressively more as you earn more. I have an example here. It's total income of $50,000. Well, from an ordinary income standpoint, what that means is they'll pay $995 on the first 10%, $3,669, that's 12% on the next bracket, and then $2,084. So earning $50,000 means they'll pay $6,748 in federal taxes. Now you also have state taxes. So let's say your state bracket is at 5.3%. Your marginal bracket then is those two together, the 22% state and the 22% federal, the 5.3 state is 27.3%. That's your marginal bracket. But how much did you actually pay? Well, if I look at this on the federal basis, I paid 10, 12, and 22 progressively. That's the total federal. Plus I paid 5.3% state. I paid a total of $9,373. That's assuming no deductions or other things that reduce that. So in that example, I actually paid 18.7% of my income. And that's where people get confused with ordinary income and income tax. In a progressive system, you're paying more as you make more progressively, but you'll never pay 37% of your income if you make $1 million because you paid 10%, 12%, 22, 24, 32, 35. You worked your way up progressively towards those higher levels of income. Now, the second type of tax is the capital gains tax. So what is capital gains? Capital gains is any time you have an asset that you've purchased and have a basis in that you then sell for a profit or a capital gain. Let's take a simple example. You own 100 shares of a $10 stock. You paid $6 for that initially. The capital increase at this point is $4. Now notice I said capital increase, not capital gain. If you sold the stock that $4 moves from a capital increase to become a capital gain. In other words, you selling it helped you realize $4 in profit in this tax year. So we addressed ordinary income, typically you make through your work or through your job. When you have capital gains on something you've bought and sold, there's a capital gains tax bracket. And the capital gains tax bracket is for people that have owned that asset for over 12 months. And it typically ranges between 0 and 20%, depending on your status. If you've owned the stock for less than 12 months, it flows through on your normal ordinary income tax bracket. So in other words, if I buy something and sell it frequently, then isn't that just income that I'm making through an activity? So that flows as ordinary income. It's just money that I'm making by buying and selling something. It could be doodads or widgets, or it could be stocks, right? But if I hold something for over 12 months, that's considered by the IRS an investment, and I will pay a different tax bracket on that. So let's look at an example. You own that 100 shares of a $10 stock that you paid $6 for. That gave you the capital increase of $4. Once you sell the stock, it becomes a capital gain, and you receive that $4 profit in this year. So I had a $4 profit and I owned 100 shares. That means I'm actually going to receive a $400 capital gain profit on this stock. So what do I need to know how much of that I'll pay in taxes? Well, if we look at this as an example and we say that you own this stock that you just sold for a $400 profit for 2 years, then we would say that's an investment, and we would look at the long-term capital gains rates. And we would say, hey, I'm single and I'm making $35,000 a year. What do I have to pay on that $400 I just made on that stock sale? And the answer is, I'm single, I'm making under $40,400. I pay no capital gains tax. That money comes to me free and clear. But again, thinking progressive tax system, I'm married, I'm filing jointly, and I make $150,000 a year. Married, filing jointly, $150,000. I'm in a 15% federal capital gains rate. So I will pay 15% of that $400 will be paid back to the government in the form of a capital gains tax in this calendar year. So, what if I had that investment capital gains and that $400 profit came over just 2 months? Meaning I bought something, say the stock, and I sold it 2 months later. Well, again, that's income to you. You're treating it more like ordinary income. So we use the same approach. If you're single making $35,000, I would come over and find single $35,000, and that's a 12% tax bracket. So it's just flowing through as ordinary income to me, and I'll pay 12% on that $400. Now, if I'm married filing jointly and making $150,000, I would come over here and say married filing jointly, $150,000, and as you can see, that's a 22% bracket. So at that level, that new income that I just made puts me in this bracket. I'll pay 22% of that $400 will be paid to me in the form, or be paid to the government in the form of a capital gains tax. So what about dividends? We said there are 3 kind of taxes that will be there most of our lives. It's ordinary income tax, and this capital gains, and what about dividends? Well, a dividend is any payment I receive that's a form of stock or cash based on ownership in a company. So I may own a company outright, I may have public shares, but if I receive a dividend, let's look at an example. I own 100 shares of that $10 stock. I haven't sold it. I still retain those shares of stock. but that stock pays a 5% cash annual dividend. The dividend's paid quarterly. So how would I do the math? I have 100 shares and they're worth $10 each. So that's $1,000 that I have in value right now. And this company's paying 5% of that annually. So 5% of 1,000 is $50 paid annually. But they pay quarterly, so I'm getting $1,250 every quarter. Again, there's a million different ways you can be taxed or get dividends. But these three things are critical to understand. Because when you receive a dividend, it's just like a capital gain if the company is already paying tax. In other words, if that company paid tax on their money to the government already, and now they're paying you a dividend because of the double taxation laws, you don't have to pay for that again at the same rate the company did. You're taxed as if it's just that 20% kind of capital gains type rate. If you receive a dividend and that company did not already pay taxes on it, and there's certain types of entities that pay taxes directly to you, they don't pay government, they do distributions, foreign corporations, now that is going to come to you as ordinary income. So again, you received a dividend of $50, okay? If you were able to have that as qualified income, you'd pay 20% of the $50 or $10 in taxes. But if it was non-qualified, meaning that dividend came to you as ordinary income, then we're right back to our progressive tax bracket. I received a $50 dividend. I'm married filing separately and we're making $350,000, so I go right into here, married filing separately, $350,000. So notice again, in that I'm going to pay 37% of that dividend will go back to the government. So based on a progressive system, as I'm making more, things like dividends and stuff have to be considered. The tax bracket is important in understanding how I'll be taxed. So again, the tax system is incredibly complicated, but what we're looking at here are the three key taxes to understand. When I earn income of any kind, that income tax or ordinary income that I'm traditionally receiving from my work will go into that progressive grid. But if I make additional income through capital gains or dividends, they'll be treated differently, often based on either the holding period, how long have I had that investment, over 12 months is key, or the dividends, are they qualified from a company that's already paid taxes on those dividends. In our next module, we'll look at qualified savings.